We are looking at April 2023 Fundamentals of Management Accounting. Question number 5. Summarize 4 salient features of process costing system, 4 marks. And part B, explain 2 costs that will be classified under time basis of cost classifications. And part C, highlight for benefit that a firm will derive from establishing a good costing accounting system. Now let's start with the salient features. Salient features or the characteristics of a good process costing system. Number 1, we can say that number 1, we have the production is continuous. In a process costing, the production is continuous. Number 2, we can talk of the production is homogeneous. The production is homogeneous. And number 3, we can the process is standardized. The process of process costing, the process is standardized. And then we can also say that the output of one process, the output of one process is used as the input in the next process. The output of process 1, for example, becomes the input in process number 2. Those are the 4 features of the process costing. Then but we are told that explain 2 costs that could be classified under the time base of costing classifications. We have various classifications of cost, but now we are told that we look under the time base of cost classification. Number 1, we can talk of historical cost. Historical cost. What is this cost? We can say that this is the cost ascertained. This is the cost ascertained. This is the cost ascertained and evaluated. After it has been incurred. After it has been incurred. It has already taken place. That is historical cost. We can budget for this cost, or we can account for this cost that was done in the previous period, so last year. Number 2, we can talk of a predetermined cost. Predetermined cost. What is this cost? We can say that this is the cost that can be identified. This is the cost that can be identified. This is the cost that can be identified and calculated. Of the goods and service. Identified and calculated before the productions. Before the productions of goods or service. The cost that takes place first before the productions of goods and service. Full stop. Number part C. We are told that highlight 4 benefits that a firm will derive from establishing a good costing system. The benefit that a a firm will derive from establishing a good costing system. In this case, we are just meant to highlight, for example, number one, we can say that a firm can measure and improve the efficiency. The firm can measure and improve the efficiency if they have a good costing system. Efficiency. Number two, you can talk of stock control. Stock control. The firm will be in a position to determine when to place an order or when it is reaching the order quantity or minimum stock level. Number three, we can talk of it. It can evaluate the reasons for losses. The firm can be in a position, can evaluate the reasons for losses. Can evaluate the reasons for losses. And number last, we can mention that it can help for future planning, or it can aid for future planning. It can aid for future planning. Then part D, we are told that Arama Limited is preparing its budget for the year ending 31st December 2024. It makes and sells a single product which has budgeted cost and selling price as follows. Selling price is 45 shillings per unit. Direct material is 11, direct labor is 8. Production overhead, we have a variable and fixed, that is 4 and 3 respectively. Selling overheads, we have variable and fixed, 5 and 2. Then we have administrative overhead, which is 4. Addition information. Fixed overhead cost per units are based on the normal annual activity level of 96 units. Then we are told that these costs are expected to be incurred at constant rate throughout the years. Then the activity level during the month of January 2024 and February 2024 were expected to be as follows. We have January and February units we have been given there. Then the question is asking, but for assume that there will be no stock on 1st January 2024, meaning on January we don't have the opening stock. Prepared in columnar format profit statement for each of the 2 months of January 2024 and February 2024 using Roman 1 direct costing method. Then we have indirect costing method. Now what we need to know, the direct costing method, in short, they are saying that we have to prepare the costing using the marginal costing or the variable costing. Then this one we have what we call absorption costing. Once you know that, then it becomes very easy for you. Before I proceed, let's calculate the cost per unit. Cost per unit. Cost per unit. We have direct. We have the direct material. I'm going to do for marginal or direct costing. Then I also do here the absorption, which is indirect. Now here, marginal, we have the direct material. Direct material we have that is 11. The same applies to here. We have 11. We have direct labor. Direct labor, it is 8 shillings. Here we also have 8 shillings for absorption costing. We have production overhead. Production overhead, but you're only picking here. We have variable. variable, it is 4. The same applies there, 4. Then we have the fixed. Only the absorption takes the cost at the full cost, which we are going to have 3. Here will be dash. Then when you add 11 plus 8, 11 plus 8 plus 4, we have that is 23 shillings per unit. Then the other side you have 11 plus 8 plus 4 plus 3, half that is 26. That is the variable, the cost per unit is 26. Then another thing we have to establish is whether we had the closing balance, closing inventory or not. Closing inventory. Now in this case we had a productions, units produced. We have January, then we have Feb. The units that were produced, we had 8,500. Let me carry 3 zeros there. Then the same applies here. And here the units that were produced, we had 7,750. Then unit sales, these that were sold, here they were 7,000. And then we sold here 8,750. The balance, this minus is when we are having 500 units. What we produced and what we sold, it means that we had a balance of 500. This one we are going to treat, 1,500. 1,500. This one we are going to treat it as closing inventory. Then here we had what we sold. We produced 7,500 and we sold 8,750. We are having negative 1,000. 1,000 in this case, it is our opening inventory. In process 2, we have opening inventory of 1,000, and process 1 we have January, we had 1,500 as the closing inventory. What else is remaining? I guess we have factored in all the important aspects. Now in that case we have to calculate. We have to calculate the direct costing. Direct costing. It is the books of Rama. Yes, you have Rama Limited. Just a minute. Rama Limited. We have that is direct costing method. In bracket, let me just put marginal costing. We have January, and then we have here the Feb. They're in thousands. We start with the sales. Sales, how many were sold? We had total sales. We had 7,000 that were sold, and the sale price is 45. In that case, we have 7 multiplied by 45. And then in this case, for February, we sold 8,750, or half 45 multiplied by 8,750. How much do you get? 45. 7,000 multiplied by 45. getting 315, 315. Then that side multiplied by 8750. We have 393, 393, 750. We say less variable cost. And then we just have here production. Before production, let's start with opening inventory. Opening in inventory. Remember, we didn't have opening inventory for January, and then the opening inventory for this one, it was 1000. Now we have 1000. We multiply by 23. Sorry, you have 23,000. We have the production. The total production we had how much? We were told in the question that the production were 8,500,000, and then that side we had 7,750,000. In that case, the production we have 8,500,000. We multiply by 23, and this side we have 7,750. We multiply by the same 23. Then lastly, we say less closing in inventory. Here we quote the closing inventory 1500 multiplied by 23. The answer we get we minus, and here we didn't have anything. Let's see. Multiplied by 23, you get 19,500, then 1500 multiplied by 23, had 34,500. This one we minus, we have 19,550 minus the answer, we had 161. And then this side we have a 7750 multiplied by 23 of 170, 178, 250 plus 2300. 1000, we had 201, we have 201, 250. Now we take 393, 750 minus the answer we had as the contribution. Contribution here we are having 192, 500. Then this side contribution we are getting that's 315 minus 161. We get 154,000. Then we have to less the fixed overhead, less fixed overhead. Do we have any fixed overhead from the equation? Let's confirm. Yes, we were told that fixed overhead cost per unit are based on the normal annual activity level of 96,000. Now this is annual activity level of 96,000, but remember we are only dealing with 2 months. Now 96 we are going to divide by 12 months, which we get around 8 million. 8 million. Now in that case, when we bring to our overhead, we are going to take 8 million. We multiply under these particular things. We have fixed overhead, fixed production overhead. We are going to multiply here, multiply 8 million by that one, by all these particular things, because it is we are told that fixed overheads per cost is based on that, and then the price per unit for fixed overhead we have been given. Therefore, this is what I'm going to do here. Just a minute. This is what I'm going to do here. I'm going to say that we have the fixed production overhead, fixed production overhead, which was what? The rate we have been given as 3. That case is 3 multiplied by 85. Remember that is what we produced, production. And then we have also selling and distributions. Selling and distribution. We are going to have we had variable and fixed. I guess I can just take the total, which is just 7. 7 multiplied by 8,000. Remember the 8 million we are talking about. And then we have administration. Administrative, also we have 4 multiplied by 8 million. Now when we multiply there, those figures are going to affect both January and February. We have that is 25,500. Then 7 multiplied by 8, most likely you are going to get 6,000. Then this one you get 32. The same in this case, we have that is 25,500. We are coming 56. Then 32. Then you find the total. This one we are having 56 plus 32,000. You get 113,500. 154,000 minus the answer, you get the net profit. Net profit in January as 40,500. Let's see in February, that's 25,500 plus 56 plus 32. We have 113,500. Then we have 192,500 minus the answer. We have what we call 79,000 as the net profit. 79,000 as the net profit. Sorry, I have realized that for February the production was different. Therefore, this particular figure ought to be changed. Here we are going to have 3. We are multiplying by what we produced in February, that was 750. When you multiply 3 multiplied by 750, have 23,250. Now 23,250 plus 56,000 plus 32,000. You have 111. Now I have to change this one. That is 111, 111, 250. Then we have 192,500 minus the answer. We get now the correct figure there. It was not 89, but it is 81,250. 81,250. That is doing it using direct method. Now let's do the same. Let's do the same calculation, but using indirect methods. We have the books of Rama. This Rama Limited. We have indirect costing method. Indirect costing method. We have that is January, February. We only have the slight calculations when it comes to production cost per unit, but everything remains the same. Everything remains the same. In that case, we can start with the sales. Sales, we are just going to get the same figure, which is 85. Sorry, the idea was 7,000. We are multiplying by 45. That the site we hit 8,750 multiplied by 45, which we got here 315, and then that the site we got 393,750. Then we say less. This case is going to be the cost of sales, not the variable cost. Cost of sales, we have opening inventory. Opening inventory for January we didn't have, but here we had 1,000. But in this case, we are multiplying by 26, not 23. We have 26,000. Then we have the production. We are taking production at full cost. In this case, we had 8,500. 8,500. We are multiplying by 26. Then this side, we had the production which was that is 750. We multiply by 26. Let's see what we get. 8,500. We multiply by 26. In this case, no, it made net 10. To have 221,000. Then what about 750 multiplied by 26? Get 201,500. Then we had less closing. Inventory we had 1,500 multiplied by 26. Multiplied by 26, we had 39,000, and there we didn't have anything up to 2100 minus the answer. We have 182,000. Then we have 26,000. We are adding 201,500. Have 227. The total here is 227,500. Now we take 393,500 minus the answer. We have that is the gross profit. Gross profit as 166,000. Then what about this other side? Minus 182. We have 133,000. Then we can less all other overheads. All other overheads. We had selling and distributions. Selling and distribution. If you remember, it was 8 multiplied by what? 8 multiplied by 8,000, sorry. 8,000 multiplied by selling and distribution, it was 7. Then we had administration, which also took us 4 multiplied by 8,000, which we got 56,000 to 32. The same apply to this side, 56,032. When you add, you are getting 88,000. Then the same applies here, 88,000. You can take 133 minus 88. You have the profit in this case is 45,000. Then profit the other side, 166 minus 88. You have the profit for the month of February. It was 78,000. Then are we supposed to choose? No, that was what you need to do, because the question was prepared in a columnar format, profit statement for 2 months, January 2024 and February 2024. You are to do that for you to scoop the entire 20 marks for both part A, part B, and then Roman part C, which requires you to compute. The only thing you need to master is when you are using the direct, remember we look at the variable costing or marginal costing. We only factor in the variable cost, not the total full cost. But when it's indirect, we are using the full cost at a full cost, not variable cost. That is it for question number 5